Yo, what's going on, guys? It's Edward with Crypto University. In this video, we are going to be talking about market cycles. So we're going to talk about an uptrend, a downtrend, and a consolidation, right? So in later videos, we discuss dynamic support and resistance and drawing valid trend lines. Here, we're just going to take a brief overlook at what a market cycle is and a brief overlook at what uptrends, downtrends, and consolidation ranges are. That way you have an understanding of what a market cycle is. So many traders are familiar with horizontal support and resistance zones, but some traders find it difficult to use trend lines. And that's rightfully so, since trend line analysis requires a little more discretion on the part of the trader. Trend lines are useful in helping you determine the trend as well as the strength of that trend. So if you follow the trend, half the battle is already won. I've said it before and I'll say it again. Trade with the trend because the trend is your friend. So if you trade with the trend, then you have a higher likelihood of being successful. When price is in a trend, the probability that the price will move in the direction of the trend is higher. So there's three phases in the market. There's uptrends, downtrends, and consolidations. And the combination of all three of them completes a market cycle. So in an uptrend, there is a higher probability that prices will go up. An uptrend is defined by higher highs and higher lows. So simply here to say, here's an uptrend, you have higher highs and higher lows. In an uptrend, you need to buy the dip, never buy the high, right? If you buy the dip, then you have a likelihood of being profitable. If you buy the high, you have to wait for it to come back and then go back up. So in general, you always want to go long on an uptrend and buy when the price dips. You never want to buy at the swing high because you know that price must eventually come back down before continuing to move higher. So a downtrend, there is a higher probability that prices will move lower. A downtrend is defined by a series of lower highs and lower lows. In a downtrend, you should short sell the rally. Never short at the low points. So looking at this downtrend here, go ahead and make that red. So we always want to sell or go short on a downtrend. So the ideal place to sell is when the price has a rally upwards, like here and here. You can see that prices strayed far away from the downtrend line. You never sell at the low points because the market usually has to rally up before moving back lower. And we're going to go over these concepts a little bit deeper in later videos. So for this video, you just need to understand what a market cycle is. So then we have a consolidation range. In a consolidation range, prices move sideways between a support zone and a resistance zone. Support and resistance represent key price levels where the forces of supply and demand meet. Eventually, price breaks out of the consolidation. You never know it until it happens. So looking at this chart here, we have a consolidation range where you see prices moving sideways. We can actually go ahead and define this with a box. So price is moving sideways in this consolidation range until it breaks out and breaks down. So in most trading strategies, it's easier to trade with the trend than to trade in consolidation ranges because here you don't know where it's going to break out until after it does. Whereas if you're trading with the downtrend or an uptrend, you have a higher probability to be successful. Just go ahead and draw this consolidation range over here so you can have an idea of what it is. So consolidation range, downtrend, uptrend, consolidation range. So when you're looking to trade in a currency pair, you need to first identify if the currency pair is in a downtrend, an uptrend, or a consolidation. You do not want to take a long position in a downtrend, and you don't want to take a short position in an uptrend. So the market cycle is a combination of all three of these, right? When the market breaks out of a consolidation range, it'll either go into a downtrend or an uptrend. In this scenario, we have seen a downtrend. And we'll move over to this next one here in a second. So during the breakout is the best time to go long or short. If it breaks down, you want to go short, and if it breaks up, you'll want to go long. Over here, you can see that it breaks up into an uptrend. Go ahead and make that green, and that will start a new market cycle. So now that you've seen the three market phases, we'll go ahead and try to find some of them in the wild. So basically, you'll see consolidation, then downtrend, followed by uptrend, then consolidation. Or you'll see consolidation, uptrend, followed by downtrend, then another consolidation. So let's try and find a couple examples of market cycles here in the wild. As you can see, this is a consolidation range, which is defined by sideways price action or horizontal price action. This is a consolidation range, and it's a very small consolidation range compared to the breakout that occurs next, right? So here we have another consolidation range, and price doesn't come back to a downtrend. So just because you break out of a consolidation range and enter a new one doesn't mean that it has to be immediately followed by a downtrend. The market cycle is a cycle. Earlier I said that a market cycle could be completed, but it's actually never ending. That's why it's called a cycle. So as you can see here, it breaks up again into an uptrend, so you can trade long here. Then we have another consolidation range, breaks up into an uptrend. And this is a large consolidation range here, or you can actually classify this as a downtrend. So price would come in this scenario, price breaks out up and then comes down, enters a small consolidation range here. Afterwards, it continues to go up, 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 up into an uptrend, and then flips, comes into a downtrend again. And then instead of entering a consolidation range, immediately turns to another uptrend, right? So here, after this uptrend, we have a downtrend, uptrend, and then we could call this a consolidation range. Here, price is kind of consolidating in an area. Afterwards, it breaks up into an uptrend, then falls down into a downtrend, comes up to an uptrend. So then we have a small consolidation range again. This is a large consolidation range rather, and price breaks out of this into a downtrend. So price breaks into a downtrend here. We'll go ahead and color that one red. So you can see that price is in a downtrend. Now we are currently in another consolidation range. So you could call this a consolidation range as price is within a certain range. This isn't a strong uptrend or downtrend to be able to verify. And looking back at previous price action history, we can come from all the way from where we currently were or where we had started this video and even backtrack further. So you can see here, this would be a consolidation range. From once upon a time, price broke out of this consolidation range into a downtrend, entered another consolidation range here before breaking out into an uptrend, goes all the way up, then you have a downtrend, right? So you can see here the trend turns to a downtrend, comes down, up, down. Then we have consolidation, small consolidation range where it breaks down into a new consolidation range, and then that is where our video started. So I hope this helps to clear up market cycles for you. What is an uptrend? What is a downtrend? How they play into a market cycle. And don't worry, if you didn't understand it too well in that video, we have other videos to further break down trading with trend lines and understanding support and resistance, both horizontal support and resistance and dynamic support and resistance.